Hi everyone. So Russia-Ukraine war started in February of 2022. And if you look at the charts, what you would notice is that this is Feb of 2022. And at its low, the markets corrected by roughly 20% in India. So this is the entire phase. If you look at the US, right? So if you study the tech index in the US, which is NASDAQ, what you would notice is that there the correction was deeper. The markets corrected by roughly 36%. So right now there are speculations that, hey, Iran-Israel war is blowing up. It will become the next Russia-Ukraine war. So what kind of impact it would have on the stock market and the investing world in general? So on this short video, I'll help you decode this entire point. If you're already invested in the market, how you should react to the news. Number two, if you want to build positions, then maybe markets will dip. So should you go ahead and build positions or not? So this is the clarity that you will get after watching this video. So let's begin. So first and foremost, you must look at the impact of wars in general in terms of the economy. And we will use US economy as the proxy because US is one could argue, the economic engine of growth in the world. So whatever happens in the US, it kind of reflects and spills over to different parts of the world. So if we go and study the last 4 or 5 key wars, here is the data and here are some key points that you must know. So if you study what happened in Vietnam War from an economics point of view, you will see that there was inflationary pressure and economic instability in US, experience stagnation and decline. And by how much did it decline? Well, it declined by nearly half. So this was a major correction which happened due to a war. So this was one. Then there was Gulf War. This was between 1990 and 1991. This is very similar to Iran-Israel war that is kind of playing out now, that US is not directly involved, but it is involved as a proxy. So what happened in Gulf War? So here you will see that there was short-term fluctuation in stock market. There was initial dip, but as clarity emerged around the war, that what would be its duration, etc., the markets rebounded very quickly. So there was hardly any major implication on the stock market. Then there was Russia-Ukraine. So I have already discussed that, hey, there was like a decent dip in the stock market in the US, especially tech stocks dipped quite a lot. And this was how Russia-Ukraine war played out. Now, as investors, you must do a scenario analysis. One could be a baseline scenario. One would be an optimistic scenario that war ends quickly. And one would be a pessimistic viewpoint that the war aggravates, right? So you'll study all these 3 scenarios. So here is what the scenario analysis looks like. And let's study the most optimistic scenario. So right now, one could say that the war has not become like full blown. It is still in its initial contingent limit, so to say. And what is happening is that Iran and Israel are exchanging strikes. Yes, so this is already happening, but the conflict remains contained. Now, this is kind of going away. So we are transitioning from a more optimistic scenario where this war will end to a scenario where US has gone full throttle, looks like it, right? So just recently, very few announcements were made. I'm also studying the news. But long story short, right now, it could be said that, hey, we are in like this zone where things have not gone full haywire. Okay, the US and other global powers are avoiding direct involvement. US has said something very recently. I'll just put up the news here. I don't know to what extent it will be true. I'm shooting this video on Sunday, so you'll see the implications of this on Monday. So let's wait and watch. Oil infrastructure remains intact. The Strait of Hormuz, which is an important choke point for trade flow, almost 20% of world trade flows through that choke point, and Iran controls it, so they can actually kind of shut it down. So that will not be good for the global economy. So this is like a baseline scenario, right? And if this situation is averted, for example, if Donald Trump do his usual propaganda that, you know what, I just came in, I bullied these guys, I tweeted like 5 times and the war stopped, he'll take credit, go away. So that is the optimistic scenario. Here, nothing major is going to happen. The futures markets right now indicate on Sunday that S&P 500 will open 1.5% down. So this is what the market is pricing in. So this is not like any major fall, and we will see a very sharp rebound, and we might in fact hit an all-time high, right? So this is a likely scenario. What might happen in case the scenario of optimism plays out on this war and the war ends quickly. Now let's also study the possibility that, hey, the war escalates a little bit, right? So I think now we are moving towards this stage, especially with this recent US announcement. And here what would happen is that the US joins Israel in military operations. It looks like that they are doing this, okay? Then a natural reaction to this would be that Iran oil exports would be severely curtailed. Yes, this also looks like a possibility. What this would directly do is that this will increase the oil price because there will be an oil shock, oil supply shock. This is not great for India. I think the impact on India will be much larger, right? Because we are a net oil importer country. So this is not good. And the scenario here, the forecast tells us that there could be a 10 to 20% dip depending on how severe this stage gets. In fact, what just Donald Trump tweeted, so to say, right? I mean, if that kind of plays out, this is a very likely scenario. We could see a 10% correction and we should be mentally prepared for that. Okay, so this is a very likely scenario. This is point 2. Point 3, if there is a full-blown war, then yeah, I don't know what's going to happen. A lot of bad things can happen. This can escalate into like a full-blown war. A lot of Middle Eastern countries will be involved. Strait of Hormuz, right, can be choked, right? The global trade flow will stagnate. And this we have to study with the backdrop of the war, right? So what is the meaning of backdrop of the war? So here you need to know 2-3 points, okay? So from a macroeconomics lens, there are 3 key points that you must understand. So the first key point is that just in April, couple of months back, US and China went full blown and they ended up fighting a trade war, right? Where Donald Trump flinged that, you know what, I'm going to impose like 150% tariff or whatever on China, and then China retaliated with retaliatory tariff. Now what this has done is that this has actually contracted the growth projections in the US and in the world. For example, now in 2026, it is being estimated that, hey, there will be a slowdown. Economists are predicting a recession somewhere around like end of 2025 or beginning of 2026. So that is a concern. That is a valid concern as a retaliatory step, right? Because this US-China trade war was escalating, right? Governments came out. For example, the European government came out, US government came out, Indian government came out, and they exhibited something called as quantitative easing. So quantitative easing means that they were anticipating that, you know what, boss, this US-China trade war is not going anywhere. It is going to have implications now, even if it ends quickly, because a lot of companies have decided not to expand their capacity really fast. They are worried about whatever is happening in the world. This will reflect into the balance sheet, the business prospects of a lot of businesses. So how do we support these businesses? So US, China, Europe, all these different countries started either reducing the interest rates. So recently interest rates were cut in India also. In India, we reduced something called as cash reserve ratio. I've done a video, you guys can watch it. In the US, they introduced something called as one big beautiful bill, okay, which simply meant that government is going to take on more debt and spend money. Okay, so take debt and spend money. Europe, for example, lowered its interest rates. They gave up their policy of austerity. Austerity means that government will be sensible in terms of taking expenditure. They said no, like the entire world is going crazy. Every country is taking like crazy amount of debt. We will also take debt and we will also expense out money. Okay. So all these steps would fall under QE or quantitative easing or a variant of this. In simple word, it means that the total money flow in the economy will increase, right? And as a result, you would have seen that in the last 10 odd days, right? And barring like last week, right? Just the week before that, the market started to do well, right? It was primarily due to introduction or induction of QE or quantitative easing. This was done to offset this first step, right? And the larger point here was that, hey, there were growth concerns due to US-China trade war. And in order to avert that, the central banks across the world, they started cutting interest rates, or governments in general started pushing this QE agenda. Okay, so this was a point. Now, just before like 2025, right? So especially in the year 2022, 2023, this was post Russia-Ukraine war. There was a lot of inflation in the world, right? And up until this point, the interest rates were kept high and they started to go down like this, right? And I'll put the chart here. You can see this. So the central banks were saying that, hey, we are fighting inflation. We are fighting inflation. And now in 2025, we have won the war on inflation because inflation looked largely in control. In India also, in the US also. So all these RBI central banks are very, very happy. Now with Israel-Iran war and the estimation that oil prices will go up, now inflation will come into the backdrop again. So there is a possibility that the interest rate cuts will be revised, right? So for example, the interest rate cuts, the central banks will say that, hey, you know what, this is just going out of hand. So let us increase the interest rates or at least not cut it for the next 3-6 months. So long story short, what is going to happen in the stock market is the following. And let me take you to the charts to explain it, what my prognosis on this from an investing lens would be. So my viewpoint would be the following, that we are currently here and I'm analyzing Nifty 50, the Indian market. We are likely to stay sideways, right? A little bit more, right? We will eventually hit this. This is the long-term trading channel for our market, right? We have been in this channel since 2020 start, right? And we are moving like this. This channel is likely to be followed, right? But we will go a little bit sideways, right? This sideways range could be between like 5%, right? So this is where we would go 5% up, 5% down from this range, and we will consolidate, right? So this consolidation point is like my number one scenario. Number two is that if the war ends fairly quickly, then this target, right? This technical target that I have marked out, this can be achieved. So the Nifty can rise by roughly 9.5%. I have been consistently saying that I'm 70% invested in India market and 30% I am on cash. Okay, so this is the scenario that I am kind of looking at. So in the US, my portfolio looks something like this, that I'm 22% cash, right? And rest I'm invested. So 78% I'm invested. Okay, so I am sitting on considerable cash positions. So in case I get an opportunity to get the market 10% cheap, that is the maximum fall that I see in the short term, I will go and buy. Now comes a very natural response that, hey, why are you predicting only 10%? Why not like 20%? Okay, because you showed us Russia-Ukraine war, right? So again, let's go back, right? So this was Russia-Ukraine war. The correction was 20% here. Okay, so here it was 20%. If we go to NASDAQ, so let me pull that up also. Here, the correction was 38%. So this is 38% correction. Then why are you saying that due to Israel-Iran war, the correction could be 10%, right? Why not more than that? See guys, I mean, this is an estimate. Of course, I can be off. But here is my economics understanding and investing understanding. See, during this phase, what had happened was that you need to study the story before it. Okay, so for example, if you look at this phase, this was 2020 COVID, pre-COVID, right? This point A, we made a V-shaped recovery, right? So COVID happened here, right? And the markets dipped to like 7.5, and then suddenly we were at 18,000. So at point B, right? So this was pre-COVID, point A, point B was post-COVID. Markets gave a 50% run up, one could say. And what was between these two phases? Well, this was just COVID. So it's not as if that world did better due to COVID. Economy-wise, it should have been massive damage. This was presented due to excessive money printing which took place. So this was a money printing rally. Okay. So during this phase, this entire phase, from going from point A to point B, the markets rallied by 50%. In short, they gained a lot in valuation. So in simple words, the valuation was hot. Okay, so the valuation was extremely hot. Whenever that happens, there is a cool off period. So this coincided with a cool off period. This 20% dip was a valuation correction that happened in the Indian market. Right now here, what has happened are two things. One is that this dip that you see, this has happened. Why? Because of US-China trade war. This just happened. This just concluded. Okay, so getting hit like every 2 months with a 20% down is, I'm not saying it's impossible, but it is highly improbable. Okay, so this is one. Second is that if you study the valuation at point C, you will realize that at point C, markets are neutral. They are neither undervalued, definitely not undervalued, but they are also not definitely overvalued. Okay, so the correction is unlikely to be more than 10%. So that is how I'm gearing my portfolio. In case I get a 10% more correction, I will most likely invest majority of my cash positions and I will sit and watch how it plays out. Please remember the last point that I'm going to speak about, that all the modern wars, be it like Russia, Ukraine, or India, Pakistan, all the new wars that are being fought, right? They are not any more news to the market, right? These are expected things. The world is somewhat prepared. Unless there is a full-blown nuclear attack or something, right? I mean, these type of wars are going to create a little bit of pain in the short term. But mid-term, when I say mid-terms, between like 6 to 12 months, things go back to normal. In fact, they become better than normal. So long story short, right? I mean, I predict like maybe a 10% drop, right, on the market and then a sharp rebound as and when clarity emerges. And there is a very high likelihood that a good clarity will emerge on this war quickly. I'm not trying to dictate what the outcome would be. You guys are smart. You can predict what the outcome of this war would be if you have been doing a little bit of reading, but I don't want to give my viewpoint on how this war will end. Many of us are geopolitical experts, so they would anyways know. So there is no point in me commenting on that. So yeah, so long story short, in case you are fairly invested in the market, do not panic. In case there is a short-term correction, just go through it. Not a big deal. In case there is a correction and if you want to add new positions, very good time to add. I'm not saying that take advantage of this. This is a humanitarian crisis. We should look at it separately. But from an investing lens, yes, it kind of makes sense to double down on your positions and just wait, right? Thank you so much for watching. I hope that you enjoyed this quick commentary. Give it a thumbs up and I'll see you soon.